Hello, hello, hello. This is Cobb Carter, and welcome to Mike Cobb's Offshore Investment Report. A very, very special show today for you because we're going to be talking about and you know what? If I were you, folks, I get your composition book and your pen because it's this good. It's this good. We're going to be talking about emerging markets in Central and South America, all the way up to mature markets, how to minimum investment, maximum return. So, Mike Cobb, come in if you will.
Knock, knock. Hey, how you doing, Carter?
Welcome, welcome.
Wow.
I'm good.
Yeah, good. Yeah, no, I'm enjoying a very nice spring day today. The weather has maybe turned for good. I don't know. We could always get another snowstorm, but my goodness, out playing with the dogs today, it's been delightful. Probably 65 or something. Nice.
It is. Here in York, it's 65 now, and over the weekend we had 6 inches of snow.
Yeah, exactly. We had about 4.5 here, right? So
that's very, very, very cool. But today, we want to help people escape all that and get to the sun, sand, and surf. Okay.
Yep.
In Central and South America, where you have 5 residential resort communities, which are the folks, the creme de la creme. They are Mike Cobb communities. And Mike, today we're going to talk about how folks know how to evaluate investments down there. You're the Offshore Investment Oracle. This is the chart that is on your website. Okay.
Yes. Right.
So we're going to take people up and down that chart, folks. If you want to tune in and tag along, there is the website itself. You go to the ecidevelopment.com, click on, now I have to read it here. I can't believe it. Oh, our advantages. Go to the fourth button down, and this chart will come up. Okay, but we'll keep referencing it for you, Mike. We have alluded to this on shows before about the investment return curve, you call it.
Yeah,
right. I mean, this is original with you, the investment return curve, where on your chart here, you start down with Nicaragua, go all the way up to Costa Rica.
Yeah.
Okay.
Right.
Helping people understand it's kind of a ratio, the amount you have to invest and the kind of return you can get and the maturity all built in. Lay it out for us. Lay it out for us.
Yeah. And it was something I kind of developed maybe 20 plus years ago now as a way to explain emerging markets, right? The developing world from an investment perspective. And I call it the investment return on investment curve. But actually, what I really like to call it whenever I'm giving presentations, I call it the popularity curve, because the different countries or the different locations within a country, I have put on there with a very simple question I asked myself. I said, if someone from York, Pennsylvania got married this weekend, where are they going on their honeymoon next weekend? Right? Pretty simple question. Where are you going on your honeymoon? Right? You know, and you know, maybe Paris, but let's take Europe off the charts for a second. Where are you going in Latin America? Right?
Yeah.
Well, tons of people going to Cancun, Mexico, right? Cancun is at the pinnacle of this popularity curve. Everyone's going to Cancun. Nobody's afraid to go to Cancun, right? On the other hand, a country like Nicaragua at the very bottom of this curve, not very popular. People, very few people from York, Pennsylvania taking their honeymoon to Nicaragua, right? And then the other countries.
I think you're probably right about that.
Yes. Yeah, right? Yes. Yeah. And so, this idea, this notion of popularity, and I'm talking about US and Canadians, North American popularity, right? This notion of popularity brings a lot of information to the investment world. Something that's really, really popular is priced higher because, it's people perceive it as worth more, right? Supply and demand.
Yeah.
Something that's unpopular is priced a lot less. And so when you look at this curve, a country like Nicaragua, even a country like El Salvador that's been out of favor for a long time, these countries aren't very popular. And so you have this incredible value opportunity, right? If you say, look, I want to pick up a piece of property somewhere and my time frame is, 5, 10, 15, 20 years. Like, I wouldn't buy property in Cancun. I mean, it's still going to appreciate, but the increase of appreciation is tapering off, right? I mean, because it's already priced way up. If you said my time horizon is, say, 10 plus years, I would say you need to be looking for a property in a country like Nicaragua, a country like
Excellent.
El Salvador, because it's very unpopular today. But they've come a long way in popularity, but they still have a long way to go. And this
Good.
rise, I mean, if you pull up your curve, I have my copy here,
Chart.
which is
There
in
we go. There we go.
the
Yeah.
consumer resource guide, right?
Nicaragua way down at the bottom.
Down at the bottom, right?
Okay.
And so you've got a country like Nicaragua at the bottom, and it's got the opportunity to just soar up this curve as it becomes more and more popular. And when that happens, two things happen. A, the price of real estate goes up, because that's just what happens when countries become more popular. But the other element in this chart is we talk about cash flow. Again, if we think about somebody taking a vacation, taking a honeymoon, this is what it takes for a property to rent successfully, right? I mean, if you're going to rent it to somebody, you're going to rent it to a vacation or a honeymooner. And if it's not very popular, not many coming, right? On the other hand, a place like Cancun, it's got a ton of people going there. So you got lots of volume, lots of tourism traffic, lots of people renting homes and condos. The trade-off is to get that high volume of occupancy, you're going to pay a lot more for the property, right?
Right.
On the other hand, if you say my time horizon is 5, 10, 15, 20 years, you can lock in a very low cost basis on a property. Yeah, you're going to get a little slow start with your property rentals, but as it becomes more popular, more and more people will rent it. Two things happen. The value of your asset goes up, which is bonus in my opinion. But the other thing that happens is, let's say today, an average nightly rate in Nicaragua, an oceanfront condo in Nicaragua, and I know this because we own them and we rent them, right? It's about $150 a night, right? For an ocean. There you go.
Right
yeah,
there.
thanks, Carter. Right, $150.
Pacifica.
Grand Pacifica, right? So an oceanfront condo right there in that building in the distance, right? $150 a night. You are looking at the Pacific Ocean, 50, 75 feet away, $150 a night. And you can buy one today for about under $175,000. I think it's $159,000 or something. Anyway, so you could buy it for $175,000 or less, right? And your rental is $150 a night. And you'd say, okay, what kind of occupancy? Let's say it's 30% occupancy, right? I can't do the math on that. It's roughly 100 out of 365, right? It's a little less than a third. But anyway, let's say it's 100 nights. Your gross revenue would be $15,000. You probably have some, there's a rental split, maybe a third of it's gone. So you end up with 10 grand on $175,000 investment. Okay. I mean, it's 6%. I don't know, I'm making up numbers. I'm close on that, right?
Yeah.
About a 6% return.
That's good though. It's good.
But two things will happen. 5 years from now, assuming, and these are assumptions, that Nicaragua becomes more popular, and it has over the last 20 years. I think it will continue to be. So now all of a sudden, instead of $150 a night, you're getting $175, $180 a night. It's more popular, right? There's more demand. But your occupancy, because it's more popular, goes from 30% to 40% or 50% or whatever it is.
Excellent.
So you're getting a higher ADR and a higher occupancy rate. But you own it for $175,000, right? And that's your basis in it forever, right?
Fantastic.
Right. Now, some people look at the other end, say, hey, I don't mind paying more, but I want to get something that's kicking off 60, 70% occupancies at $250, $300 a night, right? A condo in Cancun, for example, or the Pacific side of Costa Rica is, one of the examples we use, right? And so you'd say, all right, well, instead of $175,000, I'm willing to pay, $500,000 for an oceanfront condo or whatever the number is, right? But I'm going to get $250, $300 a night for it. Okay, and you're going to get 60% occupancy. Run the numbers, and they actually pan out about the same. That's what's kind of interesting, Carter. Like your investment is much higher, right? But your occupancy and your ADRs are higher, so you end up with about the same net return. And so you get good cash flow, right? That if you're looking for good cash flow, you get the good cash flow, right? The thing you miss at the higher end is the appreciation of that asset.
Exactly.
Over time,
I was just going to say that. Absolutely.
Yeah. Right.
Now that is the look. If you look at the chart, you mentioned Pacific Costa Rica.
Right.
Yeah, there it is, right at the top. Way down at the bottom, Nicaragua, 500,000 at the top, 175 at the bottom. By the way, I noticed where I bought 2 homes, Honduras didn't even make the damn chart.
You have an old chart. We've updated it, Carter, and we actually have Honduras on there now. So yeah.
Thank God. But let me point something out about appreciation, because I just happened to do some research on this for a column for Offshore Club. The 50 years ago, and these are real figures, and you'll appreciate it because you are the investment oracle when it comes to real estate. 50 years ago, if you bought a lot in Sugarloaf Key, Florida, it's one of the keys, I think it's northeast of Key West.
Yeah.
$10. You get one for $10. Now the homes average $3 million.
Right.
Yeah.
Right.
Somebody said, well, 50 years is a long time. I said, you don't have to tell me 50 years is a long time. But
Yeah.
you know what? I'd like to have I'm 75. I would wish I had done it when I was 25.
Right.
So that's the advantage. And you just said it a few minutes ago of the appreciation at the Nicaragua level.
Right. Right. So two other
That's
points.
Incredible.
Yeah. Two other points I want to make. If you look at that chart again, hold it up, Carter, what you see is Costa Rica is actually on there 3 times. At the very top, you've got the Pacific, then you've got the Highlands in the middle, and then you've got the Caribbean that's not very popular. And one thing to always remember when we're looking at countries is countries aren't one thing. Like the United States is a great example. United States is a lot of things. It's desert Southwest. It's rainforest in Seattle. It's a giant city called New York City, right? I mean, it's got big farming areas in the middle. And, you got America, US is not one thing. And Costa Rica is not one thing. So as we get into this chart, this is a very simplified chart, but we put Costa Rica on their 3 places to highlight the importance of understanding that a country is not one thing. Different countries are many things in terms of a tourism or popularity perspective. And so we need to understand that while the properties on the Pacific side of Costa Rica are very expensive, the properties on the Caribbean side are not very expensive. The beautiful thing about that from Costa Rica's perspective, or from a consumer looking at Costa Rica perspective, is that you can still be in a very, very, very popular country, Costa Rica, and find an undervalued market there. Right. Again, this kind of thin slicing is really important. In fact, Carter, we're gonna have something in Costa Rica likely in the next, 60, 90 days. We'll be announcing it soon. I'll make sure you hear about it first so you can let folks know. But
in which place? Which one of these places?
Caribbean side. We're going to be on the Caribbean side.
Excellent.
Right. So again, it's that value proposition for folks who want to hear about it first and have the opportunity to, get that $10 lot in the Keys that's now worth, $3 million, right?
Yeah.
Right. Those are the kinds of opportunities we like to bring to folks. Look, if you want a condo in the Guanacaste, you don't need me. You absolutely run off to the Four Seasons, the JW Marriott, the Playa Conchal. I mean, there's tons of great properties over there for $500,000 and up. You don't need me, right? But if you're trying to figure out how to get a value proposition and something a little lower on the curve that'll cash flow nicely in the short term and cash flow tremendously over time, like that's where our expertise as developers in the region for 26 years really matter, Carter.
Fantastic. Now, one place I noticed, and you mentioned this chart is a little dated because but Belize is right there in the middle.
Yeah.
I think that right now, and I know you're limited to how much you can really get into this, but I think because of the Marriott ventures that you are doing, that I would think that Belize may have moved up a few steps on there. What do you think?
Well, that's interesting, Carter. I'm glad you brought it up. It was sort of the last point on the chart that I wanted to make. A country like Belize, in this case, Belize, not like Belize in this specific case, is really in the sweet spot of the curve, because what's happening is, in the financial world, people like to use the word arbitrage, right? Oh, arbitrage, right? And sometimes it's turned around as a bad word. But all arbitrage really is the difference between what's known and what's not known in the marketplace, right? I call it the information gap, right? There's this information gap, and whoever can run to the middle of that information gap and figure it out first makes money. And so Belize, there's this incredible arbitrage situation. You've got a country that went from, when I first started going there, I started going there 28, almost 29 years ago now. But anyway, we've been working there for 26 years. And when I went there, 28 years ago, like it was way down where Nicaragua is today. If you were a serious diver or you were a serious fly fisherman, you knew where Belize was. If you were Joe Schmo on the street or Mike Cobb sitting in his office in a computer room in Springfield, Virginia back then, I didn't know where Belize was. My buddy Joel Nagel said, "Hey, Cobb, you want to go to Belize this weekend?" I'm like, "Absolutely." And I'm like, "Where's Belize?" I didn't even know where Belize was, right? But now, Carter, They're
Yep.
giving away free weeks in Belize on Wheel of Fortune magazine or
Yeah.
Wheel of
Yeah.
Fortune TV show, right? And so,
Yep.
like, so all of a sudden, like, it's become popular. Here's what hasn't happened. The type of product in the marketplace is just now starting to emerge, which is branded product. Look, if you're a serious diver, serious fly fisherman, you don't care where you stay. You'll stay at the Mike Cobb Hotel. You'll look online. You'll be like, ah, it looks all right to me, because you're only going to do one thing in your room or two: sleep and take a shower. That's it. Like, literally, you're going to go to bed after you've been drinking. You're going to get up in the morning. You're going to go fly fishing or diving. You don't care.
Yep.
Mainstream travelers want something different. They want that experience. They want that vacation experience, and they trust brands to deliver it. And so what we saw just about 4 years ago now was that the Hilton company, one of their properties called Curio, it's sort of it's like an autograph in the Marriott family. Marriott has the autograph, Hilton has the Curio. Well, we now have a Marriott autograph and a Hilton Curio on Ambergris Key. We have the Best Western franchise for that mainstream budget traveler, right? Mainstream middle-class traveler. We also have the franchise to build the Marriott Resort and Residences property on the water. These are the first two branded hotels are open. The next two branded hotels we are bringing to market, and we have both of those franchises. But what we're talking about here is this arbitrage situation where, look, in the next 10 years, the number of branded hotels will go from 4 to 20, I'm guessing, or 10, 15, right, in the next 10 years. And so you want to be there first. And this is the opportunity because, again, the type of product and the supply of product has not caught up to the popularity. And so this information gap, right, is where we as investors have a tremendous amount of opportunity to get in, provide the service or the product, or both in this case, to a consumer, and absolutely knock it out of the park. Yeah.
All right. Let me nail something down here, some advice, okay? And this may be a little embarrassing for you, but it comes from the heart, and I think it's some of the best advice I've ever given on any Offshore Club podcast. I would suggest to people, follow Mike Cobb's investments. Follow Mike Cobb's investments. We have this chart, and if you look at it, folks, you see he invested in Nicaragua. It's at the bottom now. It's going to go up that curve. You invested in Honduras. You've just invested in Honduras at every time you come up.
Yeah, the reef. The reef.
The reef. The reef. Folks, what that tells you, get in Honduras now while it frankly is dirt cheap, because it's, let's call it the Mike Cobb curve. It's going to go up. It's kind of like they tell you, if you're in the desert and you need water, follow bees. Folks, follow Mike Cobb. Okay, he bees the one to follow. It's just that simple. And I believe it. And so another area that you've just invested in, we did almost an entire show on it a couple of weeks ago. El Zante, El Salvador. I would imagine El Salvador is below Nicaragua on the Mike Cobb curve.
They're all three. Honduras, Nicaragua, El Salvador, kind of all grouped at the bottom of that popularity curve. I don't, which one's more popular, less popular. But let me just say this: all three of them in the U.S., North American, Canadian marketplace are not very popular. Very few people taking their honeymoons to any one of those three countries.
Right.
So this is the buying time. This is when you want to own the property. You want to own it when it's inexpensive, and it is inexpensive now. And and people always talk about risk, right? Oh, political risk, that risk. Hey, look, I get it, right? There is the possibility that they'll never become popular, right? But I don't know. I let me just say this: as a company, we are absolutely making big bets and strong bets in all three of those countries. And personally, I have investments in Nicaragua. I don't have any in Salvador yet, but I will. And I don't have any in Honduras, but I probably will there too. I have not, I'm a little ashamed to say, I have not been to that site to see it. Our people have, many people in our company have, I just haven't. But yeah, I'm bullish on all three countries. And again, personally, have a lot of property in Nicaragua because that one's the one I know the best. I lived there for 14 years, and it's the sleeper of all the countries right now, Nicaragua. Yeah.
That's fantastic. All right, folks, that is advice you can take to the bank. At that lower level, get in at the emerging markets, Honduras, Nicaragua, El Salvador.
And Carter, if you're not quite that, I don't know, risk tolerant, right? Because it's risky, right? If you're not that risk tolerant, Belize again is right in the sweet spot of the curve. Owning a Best Western studio condo for $125,000 on Ambergris Key, right? That one is almost a no-brainer, right? And you can finance 80% of it. So what is that? 12 twice, 25, whatever, 25 grand. Right? 25 grand down, you can finance the rest. That one's almost a no-brainer. And we've had a lot of folks stepping up. In fact, we're about ready to break ground on our next condominium building with the next 26. And I think it's actually sold out, and we're pre-selling the next building now. So good stuff happening in Belize. If you want to be a little higher on the popularity curve, but still pick up some of that arbitrage, right? Of not quite popular enough to really be known by everybody, but certainly headed in that direction fast.
Which is fantastic. All right, folks, you heard it from the Offshore Oracle. Seriously, go to ECI Development and figure out where Mike's going. Go where he is right now and follow his lead elsewhere. And that is where the smart money's going. Mike, thank you. This has been great. And check out the curve, folks. Go to the website, look at click on advantages. That's the fourth button down.
And Carter, one more. Check out the Consumer Resource Guide.
Yes.
Get a copy of the Consumer Resource Guide. It has the chart in it, but it's also got the 15 questions you should ask when you buy property overseas, and some other articles that I've written over the years. So great resource for folks looking at property overseas.
Thank you, sir. This has been great. Carter. It's been great advice. I appreciate it. Thank you, folks. That is money in the bank. Okay. When you can follow the lead of the Offshore Oracle day after day at ECI Development, grab it, do it. Okay. Remember, he's talking those lower levels: Honduras, Belize, El Salvador, mid-level Caribbean, Costa Rica, and Belize in the sweet spot right now. So, all right, folks, that's it. You can't ask for more than that. All I can tell you is, as I tell you every episode, let's do this thing.